The global auto industry just got hit with a thunderclap, and it came from Mercedes-Benz. In a move no one saw coming, the legendary German automaker has just dropped a bombshell announcement that's sending shockwaves through the entire car market. Overnight, investors are panicking, dealerships are on edge, and rival companies are scrambling to respond. Something massive is happening behind the scenes, something that could completely upend how cars are sold, built, and even valued. The luxury giant, once the ultimate symbol of stability and prestige, has just made a decision so drastic that analysts are calling it the beginning of the great automotive reset. So what exactly did Mercedes-Benz announce? Reports confirm that the company is overhauling its entire production and pricing strategy, cutting back on several luxury combustion models, slashing EV prices, and restructuring its global operations to focus almost entirely on electric and next-gen mobility. But this isn't a slow, careful transition. This is an emergency pivot, a sudden shift, triggered by collapsing EV demand, rising inventories, and growing pressure from Chinese automakers flooding the market with cheaper electric models. What was once a symbol of exclusivity is now at the center of a price war that could redefine the value of luxury itself. The reasons behind this move run deep. Internally, Mercedes has been facing growing strain from slowing sales in key markets like Europe and China, as well as rising production costs tied to battery materials and software integration. Externally, the global economy is showing signs of fatigue. High interest rates, tightening credit, and waning consumer confidence have all made big-ticket purchases like luxury cars harder to justify. Add in an oversupply of unsold EVs and shrinking profit margins, and the pressure cooker finally exploded. Executives at Mercedes reportedly called this a survival phase, not an evolution, signaling just how serious the situation really is. The fallout has been immediate. Within hours of the announcement, shares of major automakers tumbled, and suppliers began issuing warnings about lower demand forecasts. BMW reportedly held an emergency board meeting. Tesla quietly adjusted its pricing in Europe, and Toyota is said to be reevaluating its own EV rollout strategy. The industry, once built on decades of slow innovation and predictable cycles, is suddenly in chaos. No one wants to be the next company caught off guard, and no one knows how deep this crisis will go. Consumers, meanwhile, are torn between excitement and confusion. On one hand, buyers are thrilled at the possibility of lower prices and incentives as luxury automakers fight for survival. On the other, there's growing anxiety. What happens to resale values? What if today's $100,000 electric Mercedes is worth half that in a year? The uncertainty is feeding a strange mix of frenzy and fear across the market, as people rush to either buy before further disruptions or wait for even bigger collapses. Dealerships are feeling the pressure too. Many are sitting on high inventories purchased at pre-crisis prices, now watching their value crumble. Used car lots are bracing for a tidal wave of luxury EVs returning from leases with plummeting resale value, threatening to drag down the entire secondhand market. What began as a Mercedes issue is quickly morphing into a global market contagion, the kind that could rewrite every rule the auto industry has lived by for decades. And beyond the showrooms, the ripple effects are already starting to hit banks, leasing companies, and credit markets. With falling car values and rising defaults on auto loans, financial institutions tied to vehicle lending are tightening their standards, a move that could make borrowing even harder for everyday consumers. Economists are warning that this might not just be an auto industry problem, but a potential trigger point for a broader credit shock. The car market isn't just cooling, it's unraveling in real time, and Mercedes-Benz may have just lit the fuse. And what's unfolding now feels less like a corporate adjustment and more like the opening act of a full-blown economic storm. Industry insiders say this could be the moment the luxury illusion finally cracks that decades-long idea that premium automakers were immune to market turbulence. But with Mercedes-Benz now slashing forecasts, cutting production, and rethinking its entire pricing model, even the titans are bleeding. Analysts are calling it a domino effect, one that's already starting to tip. Suppliers who built entire operations around steady Mercedes contracts are suddenly staring down canceled orders and shrinking profit margins. Logistics networks are freezing up, factories are halting shifts, and the whispers of layoffs are getting louder by the day. Behind the scenes, governments are watching nervously too. Germany, already grappling with economic stagnation, relies heavily on its automotive exports. If Mercedes stumbles, it's not just a company problem, it's a national crisis. In China, regulators are pressing local automakers to capitalize on the chaos, pushing aggressive export plans aimed directly at Europe and North America. The balance of power in the global auto market is shifting, and fast. What once seemed impossible, Chinese EVs outselling European luxury cars, is suddenly within reach. Mercedes' bombshell may have opened the door for a complete realignment of the global automotive hierarchy. Meanwhile, inside boardrooms across Detroit, Tokyo, and Seoul, panic meetings are being held to map out survival plans. Ford and GM are rumored to be accelerating hybrid production again, quietly backing away from their all-electric pledges. BMW is scrambling to reassure shareholders that its EV rollout remains on track, while Tesla, once untouchable, is facing new pressure as its margins shrink in the face of relentless competition. It's no longer about who builds the best car, it's about who can stay solvent the longest. The shock is also reverberating through the luxury lifestyle sector. Leasing companies that specialized in high-end vehicles are reporting record cancellations. Insurance premiums for EVs are climbing, as repair costs skyrocket and resale values nosedive. Even the ultra-rich, long-considered insulated from downturns, are starting to hesitate before signing on for their next S-Class or EQS. The aura of luxury no longer feels untouchable, it feels unstable. And perhaps the most unsettling part of all this is how quickly it happened. Just months ago, the narrative was that electric vehicles were the unstoppable future, the gold rush of the next generation. Now, the same companies that poured billions into that dream are being forced to hit the brakes. The market is flooded, demand is thinning, and consumers are losing confidence in technology that was supposed to save the industry. The cracks are widening, and for the first time in decades, it's not clear who, if anyone, is in control of the wheel. But what happens next may be even more explosive. Behind closed doors, rumors are swirling that other major automakers are preparing their own emergency announcements, desperate attempts to stabilize their brands before the market collapses further. Investors are bracing for impact, analysts are warning of an automotive recession, and whispers of a government intervention are beginning to surface. If Mercedes-Benz was the first domino, the rest of the industry might be seconds away from toppling right behind it. And now the tension across the global auto landscape is reaching a breaking point. Supply chains that once moved with clockwork precision are now seizing up as uncertainty ripples through every layer from raw materials to retail. Battery suppliers are renegotiating contracts, fearing that falling demand will leave them sitting on billions of dollars worth of unsold inventory. Shipping companies that once prioritized EV transport are diverting resources elsewhere, unsure if those massive car carriers will even be needed next quarter. It's as if the entire machine built to fuel endless growth has suddenly hit a wall and no one knows how to restart it. Within Mercedes itself, the internal panic is palpable. Leaked memos suggest that executives are debating radical options, from merging divisions to offloading entire model lines that no longer align with their shrinking profitability goals. Engineers are being told to prioritize survival over perfection, a stark contrast to the brand's historic obsession with craftsmanship. For the first time, whispers of brand dilution are being spoken aloud as the company faces an impossible choice: cut costs and risk its legacy, or preserve its image and risk financial ruin. The leadership knows one misstep could send confidence spiraling even further, and in this market, confidence is everything. Meanwhile, dealerships are experiencing a kind of whiplash. One day, they're celebrating strong pre-orders and electric demand. The next, they're getting word that shipments are being delayed, canceled, or repriced entirely. Sales teams can't even guarantee pricing stability for customers signing contracts. Cars that were once exclusive are suddenly available at deep discounts, fueling a strange mix of excitement and dread among buyers. On social media, videos are going viral of dealerships slashing prices on models that were sold out just months ago. It feels like a slow-motion collapse visible in real time, but impossible to stop. The shockwaves are also hitting consumers in unexpected ways. As prices tumble, financing terms are tightening. Banks are becoming cautious, wary that the collateral those once valuable vehicles may no longer hold their worth. Auto loan defaults already on the rise are creeping higher, especially among buyers who purchased luxury EVs at peak prices. The dream of owning a brand new Mercedes, once a symbol of financial success, is now a potential liability. Families are realizing their investment on wheels is depreciating faster than they can pay it off. The emotional connection to the brand, that promise of timeless prestige, is beginning to fracture. And while the luxury market burns, the used car ecosystem is bracing for its own reckoning. Auction houses are reporting a flood of trade-ins and lease returns, many of which are electric models that no longer command premium prices. Dealers are slashing bids, used EV lots are overflowing, and consumers are caught in limbo, not knowing whether to buy now, wait for another drop, or exit the market entirely. For decades, Mercedes vehicles were a safe store of value, a status symbol that held strong even through recessions. Now that certainty is evaporating, and with it, the stability of an entire sector built on that trust. Yet behind the panic, something bigger seems to be taking shape, a quiet realization that this isn't just a Mercedes problem or even a car market issue. It's a symptom of a larger economic shift, one that's exposing how fragile modern consumer finance really is. The auto industry, long a barometer for global demand and middle-class confidence, is flashing warning signs that something deeper is breaking beneath the surface. Analysts are now asking the hard questions. If a powerhouse like Mercedes-Benz is struggling to adapt, what chance do smaller brands have? And if this spiral continues, what does that mean for the millions of workers, investors, and consumers tied to an industry worth trillions? Because the truth is, this may only be the beginning. Rumors are swirling that even more drastic announcements could follow: factory closures, canceled EV projects, and possibly mass layoffs across multiple automakers. The question isn't just how Mercedes will survive this meltdown. It's whether the entire global auto economy can survive what's coming next. And now, as insiders scramble to contain the damage, a darker undercurrent is emerging. Whispers of collusion, quiet government talks, and emergency financial backstops being negotiated behind closed doors. Sources close to the European Central Bank suggest that several major automakers, not just Mercedes-Benz, have begun lobbying for stimulus measures to stabilize the collapsing car market. They're asking for loan guarantees, tax relief, and even direct subsidies to offset massive EV inventory write-downs. It's a stark reminder of 2008, but this time, the crisis isn't coming from banks or housing. It's being driven by cars sitting unsold in lots around the world. At the same time, market analysts are warning that investor sentiment has turned toxic. Stocks tied to automakers, parts suppliers, and EV startups are being dumped at record pace. Hedge funds are shorting auto shares, betting that the turmoil has only just begun. Even long-term investors who once saw the automotive sector as untouchable are now quietly retreating. The financial press is calling it the Mercedes contagion, a phrase that captures how a single decision, a single announcement has cascaded into a full-blown confidence crisis. For every percentage point Mercedes stock drops, ripple effects spread across Japan, Korea, and even Wall Street. And yet, as chaos builds in the financial world, consumers are living out their own version of the crisis on the ground. Auto repair shops are overwhelmed with calls from owners looking to delay new purchases and extend the life of their current vehicles. Leasing companies are revising contract terms on the fly, unsure how to value cars whose prices are falling by the week. Even rental companies are getting hit. Fleets full of luxury EVs bought at premium rates are now depreciating faster than their balance sheets can handle. It's as if every corner of the transportation ecosystem has been caught in the blast radius of Mercedes' decision. Inside the company, leadership is trying to project calm. Public statements emphasize strategic adaptation and long-term vision, but leaked internal documents tell a very different story. One of emergency restructuring, paused R&D projects, and deep cost-cutting. Engineers report halted prototypes. Marketing teams are told to pivot messaging away from luxury and toward value. And suppliers are being asked to renegotiate contracts under new terms that hint at desperation. It's clear Mercedes isn't just reacting to the market, it's fighting for survival in a storm of its own making. Meanwhile, rival automakers are circling like sharks sensing blood. Chinese EV makers are ramping up exports, offering sleek, feature-packed models at prices that undercut even Mercedes' discounted offerings. Startups in Europe and North America are seizing the moment, branding themselves as the new face of innovation, while legacy automakers appear trapped by their own size and bureaucracy. Tesla, once the disruptor, is now feeling the heat too forced to defend its market share against an onslaught of cheaper alternatives, while investors question whether its dominance can last. The old hierarchies are collapsing, and a new order is forming in real time. But perhaps the most shocking development is how quickly consumer behavior is evolving. Car ownership itself, once a cornerstone of personal freedom and status, is starting to look outdated to a new generation. Subscription models, car-sharing programs, and autonomous transport options are quietly gaining traction as economic uncertainty makes long-term commitments less appealing. The luxury dream Mercedes built its empire on may be fading into something entirely different, a world where convenience and affordability outweigh prestige. And if that transformation continues, it could mark the end of an era not just for Mercedes-Benz, but for the entire identity of the automobile industry as we know it. Because what's happening right now isn't just a financial shakeup or a temporary market correction, it's a reckoning, a reshaping of value, technology, and trust. And the deeper analysts dig, the more it seems that this meltdown is only accelerating, pulling the rest of the auto world toward a point of no return. And with every passing week, the situation feels less like a market downturn and more like the unraveling of a century-old system. Production lines that once symbolized precision and prosperity are now slowing to a crawl as automakers grapple with canceled orders and warehouses filled with unsold vehicles. Suppliers who depended on consistent Mercedes contracts are reporting layoffs. Smaller firms are filing for bankruptcy, and the ripple effect is spreading into unexpected corners from tire manufacturers to tech companies that built software for luxury infotainment systems. What started as a Mercedes-Benz announcement is mutating into an industrial contagion, where no player in the automotive ecosystem is truly safe. Even national governments are starting to realize the scale of what's unfolding. In Germany, officials are holding emergency talks about potential bailouts and stimulus packages aimed at protecting hundreds of thousands of jobs tied to the automotive supply chain. In the US, lawmakers are quietly monitoring the fallout, worried that the European collapse could spill over into American markets through suppliers, credit exposure, and collapsing consumer confidence. China, meanwhile, is seizing the opportunity, accelerating export subsidies for its EV makers, positioning them as the new global standard in affordable innovation. The power dynamic is shifting, and Mercedes-Benz, once the crown jewel of automotive excellence, suddenly looks vulnerable to forces far beyond its control. And yet, amid the panic, there's a strange sense that something bigger, something irreversible is taking shape. Consumers, once dazzled by luxury badges and glossy showrooms, are waking up to a new reality. Cars are no longer status symbols, they're financial risks. The younger generation, already skeptical of car ownership, is turning to flexible alternatives like short-term leases, shared mobility programs, and subscription-based transport. The world Mercedes helped build, a world where owning a car was a marker of success, is quietly disintegrating before our eyes. Meanwhile, investors are starting to ask uncomfortable questions about what's next. If the most prestigious car maker in the world is slashing prices and struggling to maintain demand, what hope is there for mid-tier brands? If electric vehicles can't sustain profitability even with government incentives, how sustainable is the entire EV transition itself? Economists are warning that the Mercedes meltdown might not just reshape the car industry, it could expose the fragility of the entire green transition narrative, forcing policymakers to confront a brutal reality. Maybe the world wasn't ready to go all in on electrification this quickly. But what's even more alarming is that behind the scenes, the situation might be deteriorating faster than the public knows. Reports are emerging that some of Mercedes' suppliers have stopped receiving payments on time, and that banks are quietly reducing credit lines extended to auto manufacturers. If true, that could indicate liquidity stress at levels not seen since the 2008 financial crisis, a chilling sign that this isn't just an industry correction, but a financial event in the making. And if that's the case, the question now becomes not how Mercedes recovers, but how deep the damage will run before the global economy starts to feel the full impact of the collapse still unfolding just beneath the surface.